Most people think a car loan is simple. You borrow money, you pay it back, and interest is just the price of borrowing. But there's something hidden inside most auto loans that quietly decides how much money you actually lose. And it's not the interest rate, it's the way your payments are split. In fact, on a typical car loan, a huge chunk of what you pay in the first year doesn't reduce your loan at all. It goes somewhere else first, and most people never notice, because the system is designed so you don't look too closely. Let's talk about Megan. She's 27, works as a dental hygienist in Ohio, and makes around $52,000 a year. Her old Honda broke down, so she did what most people do. She went to a dealership and bought a used Toyota Corolla for about $18,500. The payment sounded fine, $387 a month for 72 months. She did the quick math. It made sense. That's just how loans work, right? She signed the papers and drove home. Everything felt normal. Until a year later. She checked her loan balance and expected to see progress. She had already paid over $5,000, but her loan had barely dropped. Only around $1,900 went toward the actual car loan. She thought there had to be a mistake. There wasn't. Most people assume every payment is split evenly between interest and principal. That's not how it works. In almost every auto loan, payments are structured so that interest gets paid first, and interest is calculated on your remaining balance, which is highest at the beginning. So in the early months, most of your payment is going to interest, not the loan itself. That's why your balance barely moves at first. It feels wrong, but it's standard math. But that's only part of the story. Here's where it gets interesting. Your loan doesn't just charge interest. It also controls timing and allocation. Every payment follows an order. First, any fees, then interest. Only after that, principal. So if interest is high, your principal shrinks very slowly. Now here's something most people never realize. Some lenders also structure the loan so that interest is heavily concentrated in the early years. That means you pay a larger share of the total interest up front, even though your payment stays the same every month. Same payment, different outcome. In a $25,000 loan, for example, a big portion of the total interest is collected in the first 12 to 24 months. After that, your payments start doing more work on the actual loan balance. But by then, the lender has already collected most of the profit. The system works because it looks simple on the surface. You see one monthly number. You see an interest rate. You see a term like 60 or 72 months. Everything feels transparent. But what you don't see is how slowly your principal actually drops in the beginning.